Your brain is hardwired to treat your future self as a total stranger, a neurological glitch that explains why a 41-year career can leave you with as little as $42,000 in savings. By identifying the 10 psychological biases that prioritize present comfort over future solvency, you can shift from failing willpower to automated systems that protect your wealth from your own biology. This is the data-driven breakdown of why you are statistically likely to undersave and the exact logical framework required to override your brain's default settings. Consider the case of a 67-year-old resident of Ohio who recently concluded a career spanning 41 years of uninterrupted, disciplined labor. She was the model of consistency, never missing a day of work and diligently fulfilling her tax obligations throughout 4 decades of service. However, upon reaching the threshold of retirement, she discovered her lifetime of effort had yielded a total savings of just $42,000. In a brutal economic reality check, that sum represents less than 18 months of basic living expenses. Her situation was not the result of a single, massive financial shipwreck, but rather the cumulative weight of 10 microscopic leaks in her financial ship. These are the same 10 errors currently undermining the majority of modern portfolios, each rooted in a psychological blind spot that your biology tries to hide from your conscious mind. The primary error involves a fundamental cognitive disconnect where we perceive our future existence as a separate entity entirely. To your brain, the person you will become in 3 decades is a total ghost. You might imagine that saving is an act of self-care, but neurologically, it feels like you are being forced to buy lunch for a person you have never met who is sitting in the back of a crowded bus. This isn't just a theory. It is a biological fact confirmed by researchers at UCLA using fMRI imaging technology. When scientists scanned the brains of subjects as they contemplated their current selves versus their retired versions, the results were startling. The neural firing patterns associated with the future self were almost indistinguishable from the patterns triggered when thinking about a complete stranger on the street. Because your brain fails to forge an emotional tether to your 60-year-old self, every dollar you divert into a 401k feels like a loss of personal property rather than a transfer of wealth. To bridge this neurological chasm, the National Bureau of Economic Research conducted a study where they showed individuals digitally altered photographs of themselves, aged with wrinkles and gray hair. This simple visual confrontation caused people to increase their retirement contributions by 20%. The shift occurred because the emotional centers of the brain finally synchronized with the logical centers. The stranger finally had a familiar face. Since you cannot walk around with an aged photo at all times, the only structural solution is to remove the element of choice. You must automate your contributions so your present biased brain never gets a chance to veto the transaction. By scheduling a mandatory 1% annual increase in your savings rate, you ensure that the system works even when your willpower fails. Remember, that person waiting for those funds isn't a stranger, it is you, perhaps a bit more tired, relying on the decisions you are making at this very second. The second subtle trap is the tendency to wait for a perfect alignment of stars before committing to an investment strategy. We often masquerade this procrastination as high-level caution, telling ourselves we will start once the car note is paid, once the next promotion hits, or once we finally master the complexities of the stock market. These justifications feel like prudent risk management, but the underlying mathematics tell a far more harrowing story. Imagine 2 scenarios involving a $300 monthly investment with an 8% average return. If you begin at age 25, you are on track to amass roughly $1,006,000 by age 65. However, if you wait until age 35 to start that exact same habit, your ending balance drops to approximately $440,000. That single decade of hesitation didn't just cost you a few $1,000s in missed payments, it effectively incinerated over $500,000 of potential wealth. This is the cold, calculated tax of compound interest. It acts like a jealous gatekeeper that doesn't care if you lose principal, it only cares if you waste the one resource you can never replenish, time. Behavioral economists define this self-sabotage as present bias, an instinctual preference for immediate rewards that blinds us to the compounding miracles of the long game. The struggle to save is not a battle of character, but a physiological war happening inside your skull. Data from Princeton University reveals a stark neurological divide. Our brains process instant gratification and long-term gains using two entirely distinct hardware systems. When you eye an immediate purchase, your limbic system, the primal, emotional engine, flares to life. Conversely, when you consider your future financial health, the prefrontal cortex, the logical, planning center, is tasked with the heavy lifting. Which of these systems do you think holds the reins of your behavior? The emotional brain has a 200,000-year evolutionary head start. This means you aren't inherently lazy or undisciplined, you are simply operating within an antiquated neurological architecture that was designed for survival, not for the nuances of modern asset management. While you battle your biology, the financial markets remain indifferent to your psychological plight. The market has one master, and that master is time. The true danger of procrastination is that the penalty for waiting is not a steady, manageable climb, it is a steep, exponential cliff. Delaying your investment by just 12 months might seem trivial, but the cost of the second year of hesitation is significantly higher than the first. By the fifth year, the price of inaction has surged. Most people wait for the agonizing realization of their deficit to finally spark action, but by the time that visceral pain arrives, the most fertile years for growth have already vanished. You are fighting against a form of psychological rust that deepens every month. The immediate solution is to trigger an account opening with whatever capital is at hand, even $50. The specific figure is secondary to the act of activation. Your objective is to smash the cognitive paralysis that silently drains thousands of dollars from your future net worth for every month you remain stagnant. The third fatal error is the habit of treating savings as a financial leftover. Most workers receive their wages, fund their current lifestyle throughout the month, and then hope to tuck away whatever meager scraps remain as the month expires. This usually results in a balance of zero, followed by a hollow promise that the next cycle will be different. It won't be, because you are ignoring a concept pioneered by Nobel Prize winner Richard Thaler known as mental accounting. This cognitive bias dictates that your brain perceives the value of money based on its environment rather than its face value. A dollar sitting in your primary checking account is tagged as spendable fuel. However, that same dollar, if moved to a retirement vehicle, is mentally reclassified as an untouchable asset. When capital is visible in your daily account, your brain's default settings view it as available for consumption. This is a persistent bias that knowledge alone cannot fix. You cannot outthink a biological reflex, but you can build a cage for it. The University of Chicago discovered that simply changing the mechanics of a 401k plan through automatic enrollment caused participation rates to skyrocket from 49% to 86%. No one received new financial training, the system simply leveraged the power of the default setting. By automating your contributions so they exit your payroll before you ever lay eyes on them, you make your own subconscious biases irrelevant. Now, we must address an uncomfortable reality regarding how we view those accumulated funds. Many employees mistakenly treat their 401k as a secondary safety net, assuming they can simply tap into those reserves if a crisis emerges. This perception of accessibility is a trap. According to the Survey of Consumer Finances conducted by the Federal Reserve, roughly 30% of laborers with retirement accounts have already cannibalized their own futures by taking a hardship withdrawal or a loan against their existing balance. They figure the money is there, it's theirs, and if something goes wrong, they'll just pull from it. Research from Princeton shows your brain processes immediate rewards and future rewards in completely different neural systems. This neurological divide explains why every time you dip into your retirement funds, you set off a devastating chain reaction of fiscal destruction that most investors fail to even calculate. Consider the decision to pull $20,000 from your 401k at the age of 35. On the surface, it looks like a simple withdrawal, but the reality is a financial bloodbath. You are immediately hit with standard income taxes plus a 10% early withdrawal penalty. By the time the government takes its share, you might only walk away with $13,000 from that original $20,000. However, the most brutal damage is the cost you cannot see. If you had simply left that $20,000 alone for another 30 years, assuming an average return of 8%, that sum would have ballooned to roughly $21,000. When you make that withdrawal, you aren't just taking cash today. You are effectively mugging your 67-year-old self. It is like cutting down a fruit tree that hasn't even grown its first branch yet. Your brain struggles to register this loss because it feels like it is happening to a complete stranger, a version of you that does not exist yet. This disconnect leads directly to a massive psychological error where the human brain devalues future losses with the same intensity it ignores future rewards. Harvard behavioral scientists identify this phenomenon as hyperbolic discounting. To your mind, the financial crisis you face this afternoon is a screaming, neon sign that demands attention. Meanwhile, the pain of an empty retirement account decades from now is a muffled whisper in a distant room. To survive this, you need a structural defense rather than just willpower. You must construct a dedicated emergency fund consisting of 3 to 6 months of living expenses housed in a high-yield savings account. This money is sacred and must never be used for anything else. While this strategy is admittedly unexciting and yields lower returns than the stock market, it acts as a firewall that prevents a single month of bad luck from incinerating your entire retirement future. If you are realizing right now that you have stumbled into these traps, do not panic. You aren't falling behind. You are waking up. Awareness is the only lever you have to steer your financial trajectory toward a better destination. If this perspective is shifting your mindset, ensure you join our community by subscribing, because we are moving into the mistakes that differentiate a comfortable retirement from one defined by fear. The initial 4 errors concern the architectural systems you establish before you even start investing in earnest. They represent the bedrock of your plan. But the territory becomes even more treacherous when you believe you have everything under control. High confidence is often the camouflage for the most catastrophic financial blunders. Mistake number 5 is the trap of the single account type. You might feel like a responsible success story because your 401k contributions are automatic and you are capturing that employer match. But there is a hidden tax bomb that few people mention until it is too late. Every cent inside a traditional 401k is pre-tax capital. This means that when you retire, the government treats every withdrawal as ordinary income. If you manage to save $1.2 million, you deserve praise, but you do not actually own $1.2 million. You own $1.2 million minus whatever tax rate the IRS decides to impose 20, 30, or 40 years from now. No advisor or government official can predict what those rates will be. Currently, the federal debt has surged past $34 trillion while tax rates remain at levels that are historically quite low. Ask yourself which way the scale is likely to tip in the future. Data from the Stanford Center on Longevity suggests a more resilient path through a concept they call tax optionality. This requires diversifying your wealth across 3 specific pillars: traditional pre-tax accounts, Roth after-tax accounts, and standard taxable brokerage accounts. The objective is to provide your future self with a menu of options. You want the freedom to pull from pre-tax buckets during years when your income is low and tax rates are manageable. The Federal Reserve Survey of Consumer Finances found that roughly 30% of workers with retirement accounts have taken a path that prioritizes ease of use over economic efficiency. Your brain is wired to view a single, solitary investment account as a polished, minimalist workspace, while managing multiple accounts feels like navigating a cluttered, chaotic attic. This psychological phenomenon, known as complexity aversion, forces you to favor a streamlined but inferior financial path over a sophisticated one that yields far better returns. Consider the cold mathematics of this bias. If you reach retirement with $1 million parked exclusively in a traditional 401k and face an effective tax rate of 22%, you are essentially handing over a $220,000 check to the government. However, by architecting a strategy that splits that same $1 million across traditional, Roth, and taxable brokerage accounts, you gain the power of tax optionality. You can choose to pull from your Roth when your income peaks to keep your tax bracket suppressed. Have you actually quantified what that looks like in tangible wealth? We are talking about rescuing tens of thousands of dollars from the IRS simply by altering the structure of your savings. You cannot wait until your retirement party to fix this exposure. The diversification must begin today. If your workplace provides a Roth 401k, consider dividing your contributions. Open a Roth IRA if you meet the eligibility criteria. For those who have already maxed out these tax-advantaged vehicles, a taxable brokerage account serves as a critical tool to access capital gains rates, which are often significantly more favorable than standard income tax rates. Each of these accounts is a distinct instrument in your orchestra. Learn to play all of them. Beyond tax structure, your brain is fundamentally ill-equipped to detect the slow bleed of hidden costs, particularly the 1% expense ratio. Because a single percentage point feels as harmless as a stray drop of water, your cognitive hardware dismisses it as irrelevant. This is a classic demonstration of ratio bias, where we judge the significance of a percentage based on the size of the current pile rather than its absolute power over time. While 1% of a starting $30,000 portfolio is a mere $300, that same 1% applied to the $1.5 million nest egg you hope to build represents a $15,000 annual theft from your future. The numbers from the Department of Labor are staggering, revealing that a 1% fee discrepancy can vaporize 28% of your total career savings. On a $500,000 portfolio held for 25 years, the difference between a 1% fee and a 0.1% fee is approximately $200,000 in lost compounding. That is $200,000 that did not vanish in a market crash, but was quietly siphoned away by fees you never physically felt leaving your hand. The remedy is the highest return activity you can perform in 15 minutes, migrating to low-cost index funds at providers like Vanguard, Fidelity, or Schwab, where expense ratios sit below 0.1%. Finally, we must confront the siren song of trying to outperform the market. It often starts with a persuasive headline or a story about a stock that tripled its value in half a year, triggering a mental whisper that tells you that you possess a unique edge. In reality, you almost certainly do not. This is not a personal critique but a statistical reality anchored in 20 years of empirical evidence. And that's not an insult. It's a statistical fact backed by 2 decades of data. Control your tax liabilities by strategically withdrawing from Roth accounts during years where your total income peaks, ensuring you dominate your financial narrative rather than reacting to it. This structural foresight is rare because the human mind is essentially a minimalist that hates clutter. While a single account feels like a neatly organized desk, a diversified portfolio feels like a tangled web of bureaucracy. Behavioral experts refer to this as complexity aversion, a glitch that convinces you to accept a mathematically inferior outcome just because it feels easier to understand. The cost of this mental shortcut is staggering. If you enter retirement with a $1 million balance in a traditional 401k and fall into a 22% effective tax bracket, the government effectively owns $220,000 of your hard-earned wealth. Contrast that with a split strategy across traditional, Roth, and taxable vehicles. By tactically lowering your taxable floor each year, you could rescue tens of thousands of dollars in lifetime tax payments. This shift from a single-lane road to a multi-lane highway must happen today, long before you stop working. Utilize every tool available, from splitting contributions into a Roth 401k to opening a Roth IRA or leveraging a taxable brokerage account to benefit from capital gains rates instead of heavy income tax rates. Furthermore, the data shows that your attempt to outsmart the market is a statistical suicide mission. Since the early 2000s, the S&P Indices versus Active Scorecard, or SPIVA, has been the definitive obituary for professional fund managers. Despite having Ivy League MBAs, Bloomberg terminals, and research armies of 50 people, more than 90% of actively managed large-cap funds failed to beat the S&P 500 index over a 20-year span. 9 out of 10 elites were defeated by a passive index, yet the overconfidence effect convinces you that you are the exception. A University of California at Davis study found that the most frequent traders actually earned annual returns 6.5 percentage points lower than the market average. Every time you pull the trigger on a trade, you are inviting a ghost into the room, loss aversion keeps you tethered to sinking ships, recency bias makes you chase yesterday's winners, and confirmation bias blinds you to contradictory data. You aren't playing a game of skill, you are navigating a minefield of psychological errors. The most profitable path is the most tedious one: buy broad market index funds through providers like Vanguard or Fidelity, contribute without fail, and stop looking at the screen. Fidelity even discovered that their top-tier accounts belonged to people who were either deceased or had forgotten their login credentials. Relinquishing the illusion of control is the most profitable trade you will ever make. Finally, we must address the mathematical danger of underestimating your own lifespan. If I asked you how long you will spend in retirement, would you guess 17 years? That is the average American estimate, typically aiming for a death at 82 or 83. However, the Social Security Administration reveals a much more taxing reality. If you reach age 65, there is a 33% chance you will cross the 90-year mark. For married couples, it is essentially a coin flip, with a 50% probability that at least one spouse reaches age 92. Planning for a 17-year window when you might actually face 30 years is a recipe for a humanitarian crisis in your own living room. Psychologists at Cornell call this focalism, the habit of anchoring your entire future to a single, optimistic date. Instead of a clean and simple expiration date, you must build a financial structure capable of sustaining you for at least 3 decades. The penalty for having too much money at 88 is a minor bookkeeping task. The penalty for having zero is a catastrophic loss of autonomy. One is a mild inefficiency. The other is a humanitarian crisis in your own life. Underestimating your biological expiration date is a systemic poison that contaminates every single cell of your financial plan. If you fail to account for the full duration of your life, your withdrawal rates will inevitably be set too high, and your portfolio will be tilted far too aggressively for your actual requirements. This is not just a single error. Longevity risk acts as a lethal force multiplier that exacerbates every other misstep you make. Consider the escalating costs of late-stage healthcare. In the United States, a private room in a nursing home now commands an average annual price tag exceeding $100,000. If you reach age 93 but fail to anticipate just 3 years of assisted care, you are staring at a $300,000 shortfall that simply does not exist in your current accounts. This isn't a doomsday fantasy, it is a mathematically probable reality that the majority of retirement plans willfully ignore. You must plan for the long haul and build a conservative buffer that feels excessive. That specific feeling of discomfort during the planning phase is actually the sensation of true structural security. This leads directly to the 9th major pitfall: fleeing the market during a downturn. Since 1928, the S&P 500 has plunged 10% or more roughly every 19 months, with catastrophic 30% crashes occurring once every 10 years on average. These shifts are not glitches in the system, they are the fundamental heartbeat of the market. Yet, panic remains a powerful motivator. Between February and March of 2020, as the market cratered by 34%, investors hemorrhaged approximately $326 billion from equity mutual funds and ETFs. By August of that same year, the market had completely reclaimed those losses. Those who retreated effectively severed their own financial limbs, while those who held their ground saw their wealth restored and expanded. Research from the Journal of Financial Planning underscores the danger of timing the market. Missing just the 10 most profitable trading days over a 20-year span, out of roughly 5,000 total days, incinerates nearly half of your potential returns. Crucially, 6 of those 10 best days happened within a mere 2 weeks of the 10 worst days. Nobel laureate Daniel Kahneman's work on loss aversion explains this behavior. Our brains register the agony of a loss with twice the intensity of a gain's pleasure. When your screen shows a 20% dip, your nervous system processes it as a 40% catastrophe. Selling might feel like applying a soothing ointment to a burn, but in reality, you are turning a temporary bruise into a permanent amputation. A Vanguard study confirms that a written plan is the best defense, as it automates your discipline before the emotional storm hits. Finally, we arrive at the 10th mistake: the absence of a concrete exit strategy. You may have spent 4 decades stacking your capital, but reaching the summit is only half the battle. You still have to get down safely. Many people mistakenly believe they can simply withdraw funds as needed, but the technical reality is far more complex. The specific order in which you empty your accounts, the exact dollar amounts you claim annually, and the performance of the market during your first few years of retirement, the sequence of returns, are the ultimate deciders. This mechanical framework is the difference between a nest egg that sustains you for 35 years and one that vanishes in 16. Most people assume they'll just withdraw what they need when they need it. But the sequence in which you withdraw, a single catastrophic market event at the start of your retirement can act as a financial wildfire, incinerating decades of preparation regardless of your portfolio's long-term potential. This phenomenon is what professional planners identify as sequence of returns risk. To visualize the danger, imagine a market that plunges 25% during your first 24 months of retirement while you are simultaneously pulling a 4% withdrawal rate. Under these specific conditions, your capital might never recover, even if the markets eventually rebound. It is a sobering reality that two identical portfolios with the exact same 30% average returns over 3 decades can end in radically different states depending purely on when the bad years occur. Retirement is not a controllable machine, it is a probabilistic storm. While the famous Trinity study remains a cornerstone of planning for its finding that a 4% annual withdrawal had a high success rate over 30 years, it relied on a specific historical timeline that may not repeat. More recent data from Morningstar indicates that a more conservative initial rate of 3.3% is likely safer for today's retirees, factoring in current asset allocations and volatile market climates. Your biology craves the comfort of a rigid, simple rule like the 4% standard, but leaning on a static number creates a dangerous gap between security and desperation by the time you reach age 85. The solution is to move away from commission-based advisors and collaborate with a fee-only financial planner to engineer a withdrawal strategy that functions like an accordion. You need a system that breathes with the market, tightening your spending in down years and allowing for more slack when growth is robust. This plan must also navigate the tax implications across multiple account types to ensure maximum efficiency. Beyond the numbers, you must prepare for the final psychological hurdle, the terrifying shift from building a nest egg to spending it. Research from the Employee Benefit Research Institute shows that many retirees actually live in unnecessary austerity, underspending because the act of decumulation feels like a visceral, gut-level loss. After 30 years of watching a number climb, watching it shrink feels like a physical wound. A professional withdrawal plan serves as your formal permission to actually enjoy the freedom you spent your entire career earning. Failing to spend is just as much of a defeat as running out of money, one just happens to look more responsible from the outside. Every one of these 10 major errors stems from the fact that your brain was built for short-term survival on the savannah, not for the abstract demands of a 40-year investment horizon. You are not inherently bad with money. You are simply a victim of evolutionary baggage. Present bias convinces you to delay, while mental accounting tricks you into spending what should be protected. Complexity aversion traps you in a single account, and ratio bias masks the parasitic nature of high fees. Overconfidence pushes you toward reckless trading, focalism blinds you to the reality of your own longevity, and loss aversion forces you to sell at the absolute bottom of a crash. You're not broken. You're running modern financial software on hardware that hasn't been updated in 200,000 years. But here's the thing that should give you hope. The survival of your retirement depends entirely on building an engineering solution for your own mind, moving beyond the exhausted reliance on sheer willpower. To succeed, you must construct a defensive fortress by automating every contribution, utilizing low-cost index funds, and diversifying across multiple account types. This tactical architecture must include a dedicated emergency fund to act as a shield for your long-term assets, alongside a formal, written roadmap drafted long before a market crisis arrives. Your strategy for extracting wealth must be as meticulous as your strategy for accumulating it. This is not about transforming your personality, it is about designing a mechanism that accounts for every biological quirk and cognitive shortcut your brain instinctively takes. The woman in Ohio who saw her future vanish did not fail because of a character flaw or a lack of industry. She worked within the limits of her understanding, but she was a pilot flying without a navigation system through a storm of invisible psychological forces. Her downfall was a failure of financial architecture rather than a failure of effort. She lacked the necessary blueprint to identify the structural traps waiting to swallow her savings. You now hold that blueprint in your hands. Once these mental triggers are exposed, they lose their ability to operate in the shadows of your decision-making process. Every future choice you face is now illuminated by this clarity. When you feel the urge to postpone a contribution increase, you will immediately recognize the influence of present bias. When the market turns red and panic sets in, you will identify the survival-driven sting of loss aversion. If the convenience of a single account tempts you, the warning of complexity aversion will echo in your mind. Naming these internal thieves is the primary way to lock the door against them. Now that the mechanics of the heist are visible, the power to protect your legacy rests with you. If this analysis has shifted your perspective, share in the comments which of these traps felt the most personal to your journey, and ensure you subscribe and activate the notification bell to continue mastering your financial trajectory.